In March of 2026, the financial markets are bracing against the threat of conflict and regime change in the Middle East. The immediate reaction is intense anxiety, closely mirroring the sudden geopolitical fears that gripped the world in August of 1990. We can measure that anxiety directly in the data. Driven by localized headlines and the threat of escalating violence, the S&P 500 has registered an 8.74% drawdown from its January peak. For historical context, investors immediately point to the Gulf War in 1990. The parallels in regional tension are obvious, and during that specific crisis, the stock market suffered a rapid decline of nearly 20%. Faced with that historical precedent, amateur investors and headline-driven traders default to panic selling. They liquidate their positions, reacting entirely to the daily news cycle rather than underlying market mechanics. Rigorous capital management requires a different approach.
We are going to strip away the emotional noise and examine the quantitative macroeconomic beta to determine if 2026 is a standard mid-cycle correction or the beginning of a prolonged period of secular stagnation. As always, this material is for informational purposes only and is not investment advice. Please consult a licensed professional. To track the exact valuation metrics we use in our models, download the Buffett Indicator app on iOS. Misdiagnosing an overarching secular trend because you are focused on a short-term geopolitical shock is the most reliable way to guarantee catastrophic underperformance in your portfolio. To evaluate the severity of the current 8.74% drop, we first have to establish the historical baseline for S&P 500 volatility. This chart tracks annual market returns since 1980. The math here is unequivocal. Over this entire period, the average intra-year drawdown for the S&P 500 is 14%, while the average annual gain sits at 12%. A mid-single-digit drawdown is a mathematical standard. It does not inherently signal a broken market structure. The strongest technical link between the market of 1990 and the market of 2026 is found in the commodity sector, specifically the 14-week rate of change for West Texas Intermediate crude. Comparing crude's rate of change in 1990 against 2026, notice the striking similarity. Both environments feature a multi-year period of heavily suppressed volatility, a tame lower bound. Then the baseline shatters. Both periods experience a sudden, violent surge in prices, breaking out of that window. If you restrict your view strictly to geopolitical tension and localized commodity pricing, the 2026 event maps almost perfectly onto 1990. Relying on one localized metric to govern your entire capital allocation strategy exposes you to severe unforced errors. We have to zoom out to the macroeconomic scale. A secular bull market is a massive, multi-decade upward trajectory. The period from 1982 to the year 2000 is a perfect example of this structure. This tracks the 18-year secular run. Embedded within is the 1990 Gulf War panic, lasting exactly 87 days. Under stress, investors compress their horizons, shrinking their worldview to this narrow window. Zooming out shows the penalty for myopia, a 417% subsequent gain. Yielding to the time horizon trap means liquidating high-quality assets during a routine, structurally normal drawdown out of pure fear. A professional investor's objective is never to minimize a localized dip or maximize an account balance at a 60-day trough. Those are short-term amateur goals. The true function of portfolio management is surviving the inevitable noise of short-term panics to successfully capture the gains between point A and point B over a decade. To determine if the current trend is breaking, we look past the oil shock to the underlying macroeconomic liquidity driving the broader system. This chart tracks the National Financial Conditions Index. Values above the zero line indicate tight, recession-prone conditions. Values below indicate loose, favorable liquidity. In 1990, the market was vulnerable, sitting in the restrictive zone. In 2026, conditions are deep in favorable territory with ample liquidity. In terms of liquidity, 2026 actually resembles the booming post-1992 market rather than the fragile, restrictive state of 1990. Price momentum relative to the S&P 500 confirms this resilience. Current momentum remains well below the zero line, a structural hallmark of an intact secular bull market. The geopolitical catalysts may mirror each other, but the underlying financial architecture does not.
The robust liquidity conditions of 2026 completely override the 1990 blueprint. Recognizing that the macro data is strong does not mean we ignore risk. We manage it using an incremental quantitative protocol called Mitigation 1. Our secular volatility model aggregates inputs from 136 distinct charts, filtering them through 489 specific questions. Allowing for zero emotional interpretation, every input is answered strictly as a 0 or 1, translating into a precise proportional cash allocation shift. The size of our defensive action perfectly matches the rate of data deterioration. As the broad market data slips incrementally, we increase our cash position incrementally. The framework makes no attempt to predict the future. It is a probabilistic reaction designed strictly to preserve capital during an extended drawdown without missing the subsequent rebound. By letting an objective flow of data dictate our exact defensive posturing, we eliminate the panic associated with a standard 14% market dip. We finalize our assessment of 1990 and 2026 by placing both charts above a rising 200-week moving average. Despite localized panic, the market structure holds firm. In 1990, the S&P 500 traded 24% above this trendline. Today, it sits exactly 23% above. The localized conflict in the Middle East matches history, but the combination of robust financial conditions, internal momentum, and firm long-term technical support definitively diagnoses 2026 as an ongoing secular bull market. To access the data frameworks discussed today, visit deepvalues.ai and subscribe to our sister channel, Deep Values, for deeper insights into investing philosophy. Generational wealth is built over decades by respecting intact secular trends, not by trying to outguess the next geopolitical shock.